Hi there. Welcome to another edition of TokStocks. I'm your host, Keir Reynolds, and today we're lucky enough to have Sean Black, Chief Investment Officer of Happy Belly Food Group, trades on the CSE under the ticker HBFG. Sean, how you doing today?
Good, Keir. Thank you very much for having me back.
We'd like to try to stay up to date with you on sort of a quarterly basis. We last spoke to you in December. We're just into April, so thought it was a pretty good time to sort of catch up. And you haven't disappointed. The last 3 months since we chatted, you guys have certainly kept up your torrid pace. Lots been going on. So look forward to digging into some of the details with you and some of the updates. Last September, in one of our podcasts that we did together, you mentioned that you're looking to grow Happy Belly to about 10 brands. If we count Via CIBO, I think you're at 7 restaurant brands and 9 overall brands, including your CPG brands. Are you getting close to your desired sort of portfolio mix of brands? What do you think?
Yeah, for sure, the goal has been pretty clear for us to reach 10 as a minimum for our portfolio. And I think, Via CIBO coming in is our largest M&A deal to date from a platform basis for restaurants and, total system sales. But we anticipate, to accelerate that as, we enter the back half of the year. A key piece of that's been the last, 3 to 6 months has been integrating the assets, each of the brands, and getting them all experiencing their own organic growth, both at the restaurant level and as well as in their unit count level. So we are slowly digesting the assets that we've brought in. You are starting to see, the last sort of 90 days where we are actively kind of getting boots to ground and signing more bricks and mortar. And I think that will continue throughout 2024. I don't see any issue from us, whether it's 3 months, 6 months, 12 months to getting to our 10 brands. Just doing the deals on the right terms, the right unit economics that we're after, that we can accelerate growth and they'll add the synergies that we're looking for. So seven is a good start.
Sure is. You've ramped up fairly quickly.
Yeah, we had a personal goal in mind in there. It took M2I 24 years from my notes to get to 9 brands, and personal mission. We'd like to beat that.
Well, looks like you certainly are well on your way. You might do it in about 2 years, rather than taking 24. You started off the year with a bit of a bang here. You announced the binding LOI to acquire 100% of Kravik Group's Via CIBO restaurant chain. What assets are you getting as part of that? And when do you think that's going to close? I think originally you were looking at sort of Q1. Any color there?
Yeah, absolutely. I do anticipate that to close in the next week or two. The biggest thing we had to do was lease assignments. As part of the journey when you're assigning or you're acquiring a brand like that, one thing you have to do when the leases are held by, if any of them are held by corporate, you need to get the landlord permission. So as a major step, I remember going through it with Extreme Pita and Mucho Burrito. We had 300 leases to assign, and that was a 6-month endeavor from legal and my partner Mark at the time, to get done. So same process here. Some parts of it you're not in control of. We'd hope to close it in Q1, but Easter, lawyers, enjoy their long weekends and every holiday that they can access. So it took a few extra days, but it is anticipated to close imminently.
Great. And maybe you could just sort of explain kind of what you're getting. You indicated earlier that it's the largest transaction to date. Pretty exciting for the business. Maybe you could just sort of jump in and explain with a bit of detail in terms of like what assets you'd sort of be getting. Are they franchised or corporate owned?
It's a 100% franchise system. In the traditional all street front stores have now been franchised. There were a few corporate stores, but they've since been franchised. And in Alberta and Ontario, current platform. So we're acquiring the current franchised assets. We're acquiring the incoming pipeline of franchisees that are, kind of mid-flight at the moment. And we're acquiring their non-traditional business, which is a ghost kitchen business that operates with Reef kitchens across Canada. So those are all included in the deal. This is a debt-free acquisition. We expect it to be coming over asset light, cash flow positive, and having with approaching a $10 million system sales. We anticipate this being very accretive and very impactful to our overall numbers as we entered 2024.
Excellent. Well, thanks for the overview there. You mentioned something called system sales. Would you mind just, for those of us that maybe aren't familiar with that term, if you could sort of explain? I guess a number of other franchise, multi-unit sort of franchise brands sort of use the same terminology. So I guess you're getting into the big leagues here and acting like them. Maybe you could just explain it. What does it mean for us?
Absolutely. If you look at this morning, like Tim Hortons, I was reading an article on them last couple of days. QSR, they've announced their intention of being at $60 billion a year in system sales, and it's a big goal for them, but that's their target, I believe, by 2025. And for us, we are very much trying to put ourselves in direct comparison to MTY and QSR and some of the brands out there. MTY. Their corporate revenue is nowhere near I think last quarter they did about $1 billion. But on average, they got recently to a run rate of about $1.5 billion a quarter in system sales, and that encompasses all of your restaurant sales. So then you derive your corporate revenue off that from royalties, rebates, construction, process management, whatever you're doing, from that number. So very much yes for us, it's a system sales target that we have internally, and once we know, you drive your top line, it will eventually help us hit our numbers on a bottom line basis. So system sales, yes, for something like Via CIBO, it's about 10 million. And we are going to actively, as you see us going forward and report Q4, Q1, Q2, as we move into 2024, we will actively report our system sales and allow people to draw a better comparison, in my opinion, as to the true scale of the company. We're not managing a business today that does 1.5 million in revenue. You're probably managing a business today that, might be doing, on a quarterly basis, might be doing, as we enter this year, we might be doing 5-10 million a quarter in system business, quarterly business. So it'll be much more reflective of the true scale of the model we have.
Excellent. And you mentioned sort of projected system sales for 2024 for these Crave It assets to be about just under $10 million. I think you put in the original press release when it was announced in January, it was going to be 9.65 million. I would assume that we can't really just take like a 5% sort of royalty estimate off of something like that in terms of what Happy Belly would get. I would assume these Reef Kitchen, ghost kitchens would not be franchised. They'd be corporate owned and you'd be consolidating all of that revenue.
Well, actually, Reef operates them and does pay a royalty as well off those businesses. So you will see us, that's a true asset light model. So you will see the full revenue off that business from a royalty perspective. And those are all part of the M&A that is pending closing imminently.
Excellent. Okay, sounds good. And so in terms of like franchise and model, there's the sort of like the royalty, the franchise like off of gross sale that you would typically get. I think you educated us a little bit on that last time. And then there's other inputs or revenue streams that you as the brand owner can receive, rebates, software, payment processor, ingredients, things like that. Are those all areas that we as shareholders should be looking forward to in the future as you continue to grow these out?
Yeah, this is the first time now where the bulk purchasing is becoming a meaningful part to our business, and will be going forward. And that's how we're going to be able to also drive real value back to the franchisees. As now all of a sudden, it doesn't matter, your GFSs, your Cisco's, your Cokes, that kind of stuff. They actively will come to the table now and want your business, and we're able to better, obtain significantly better pricing for our franchisees. So, and then what comes with that often is what's called volume rebates. So, if you do drive additional revenue, sometimes they contribute marketing dollars for you to your franchisees. Sometimes they'll provide corporate incentives, and those things will become noticeable in our P&L as we scale through 2024, and they will be impactful to our EBITDA.
And in terms of Via CIBO, could you explain a little bit about that chain? Like what type of food, what type of cuisine, how many locations, where they're operated currently?
That's right. Absolutely. The chain operates today out of Alberta and BC. If you look at Alberta, BC, Alberta and Ontario. And in Ontario, we have 2 locations open, one today in North York, another one in Ottawa. I'm actively working with Alex and the team on a couple new locations that we hope to secure this year and start to impact that EBITDA from a high level, including as it's being vended in, there's an earn-out portion to that deal. So there's a real keen interest in seeing it accelerate its growth post close, and we've been actively working together on a friendly basis to have that happen sooner rather than later. So that's a big part of it. But the main presence of stores today is in Alberta. And if you look at Calgary as our primary market, that is a very strong market for Via CIBO. First store out there ever was at Deerfoot Meadows in South Calgary. Real flagship for us. One of our former area developers and business partners, Steve Travers, is our guy on the boots on the ground in Calgary. So that brand today represents majority of the sales are pasta, pizza, sandwiches. And if you look at the representation, it's probably 60% dinner, 60 to 65% dinner business. It is along the lines of fast casual. You do come in, you order at the cash, you get a number, you sit down, they bring you your food, which is a little bit different. Focusing a little closer. Just the biggest thing we've removed out of this process is the tipping. So there's not the requirement every time you get your food dropped off your table to pay somebody 20%. Which is a big part. So we're serving our food typically. Everything you order is within 8 to 10 minutes, and the price point is significantly lower than a full serve restaurant. So today it provides great value for consumers and families across Canada. And I think there's a lot of people out there looking for better food at good value, and not everybody wants to tip. Now when I see a request on a terminal, they're asking for 30% or 35% tip on a food order.
Yeah,
I can't help but laugh. I just don't think it's. I think it's obnoxious. When brands do it. To tip people out there. If somebody wants to tip, they can. But when the lowest tip option is 25% on a pin pad, it makes just a lot of people, I think, get irritated. So we removed that out of there, and we have a great model that we believe we can scale in 24 and 25, and it gives us representation in the Italian category, which we do not have today in our portfolio. So it's also, for me, very strategic from a real estate perspective as we look to source larger locations. Via CIBO will play a big piece of that going forward.
And then in terms of Reef Kitchen, are how many of those locations are you getting, and are they operational today?
Yeah, they are operational today. There's 4 operating today, and they're very successful. We've had discussions about expanding the portfolio with them into the United States. That's probably more of a Reef-driven decision. It's not up to us because they provide the capex and they provide the team to operate them. But based on how strongly they've performed, we've had discussions about further expansion of units as well as expanding into their model in the United States.
And in terms of what do they do? How do they sort of operate? How do they sort of fit in? Ghost kitchen is kind of a broad term. There can be a lot of different sort of business that would be done within that. What's their sort of core expertise? What are they sort of doing?
What I'm going to say, as much as anything, they often go in and take over a parking lot or a downtown piece of empty real estate. They bring in their systems into almost what they call cans. They're like huge containers.
Right.
They bring them in and they operate out of those units. Full serve operational. They'll operate multiple brands out of each container. And typically, because they're in urban, they're able to access, better, I'm going to say, targeted real estate that is points of delivery, distribution points. So they have a really unique model, and it's real estate driven, making use of unused land down in urban areas.
So it is related to sort of like the Reef kitchen out of the U.S. that became famous with those sea cans.
Yes.
Sort of that they put up during the pandemic for kind of delivery only food.
That's right. That's I think it was a Travis Kalanick backed venture, the gentleman from Uber. It's exactly that. So, and it's all delivery business. And so it's great for us. There's no CapEx required, and, they use our model and, pay us our royalties on a monthly basis.
Very cool. So it sounds like potentially another brand right there.
Yeah.
Although I guess you're not really buying food under Reef Kitchen. I guess you're buying whatever would be on your delivery app. But
it is. But there's also an opportunity there's also an opportunity for our existing brands to leverage the Via CIBO relationship with Reef. So we may be able to expand our portfolio with Reef by accessing the Via CIBO account.
Hey, very cool. Well, thanks for the overview on that. So the acquisition of these assets are what we call, they're considered sort of non-arm's length. You've obviously disclosed all of that. So I guess it would have some of the principal, the existing sort of directors or principal sort of involvement. Maybe you could give a little overview on who sort of Crave It is and how it was formed and when it was formed.
Absolutely. My two original business partners in Extreme Brands, if you go back all the way, were Alex and Mark Rikiki. Mark is the financial operational mind of our team, and he was a great asset in our team. So in a deal like this, first step is bringing in the talent, right? So we wanted to bring in Alex and Mark on a full-time basis, so that post closing that's what will happen. Alex is the culinary vision leader of the brands day to day. Working with the team, working with the people and the food. That's his, in the marketing. Those are really his three core areas that he focuses on. Very much a CEO, chief restaurant officer. You can call Alex a few different things in a day, but his focus is on the brand. So post that, it'll just bring him in full time, focusing on the entire portfolio of Happy Belly, which will be great that the team will have full time access to him. And those guys were with me right from the start when we started Extreme Pita, into Mucho Burrito, then into post-selling those to MTY. In my time being done at MTY, and I rejoined them. That's when we joined and built Burgers Priest. We did fresh, and then we ended up vending those to the Recipe and Fairfax team. And now, so it's bringing the band back together. Now they're back full time in the business, and primarily focused on those roles. You'll see Mark very much focused on purchasing. Overall legal, back of house structure of the company. And you'll see Alex very forward facing in the restaurants, focusing with the individual leadership of each brand on a daily basis. So Alex will be their team mentor and team leader daily.
So I guess this now brings sort of, full alignment where everybody's sort of fully in on Happy Belly rather than having sort of outside operating a restaurant or franchise sort of business. Now it'll all be under one umbrella. Is that correct?
That's right. This is all of our assets under one umbrella. Now we have the day-to-day management team. As we've announced previously, we have our entire development team in Ontario and Western Canada. As part back in the fold and as part of the band, as we put that together. And now you see some of our top franchisees previously in previous brands quickly becoming our largest franchisees in our entire company. Like when you get one of them, one group buying 10 units from us, it's very meaningful for a company our size. And they're great guys. I'm actually going to be with them tomorrow when I land in Vancouver, Wednesday, Thursday, Friday. I'm touring real estate with those guys. We're actively looking at them. I'll be doing the belly check on a couple other brands while I'm there, and meeting with some potential, future M&A deals, as well as investor meetings that are lined up. But number one thing is I'll be boots on the ground, looking to approve further real estate or future real estate that we're about to, launch our brands into.
Excellent. I noticed from your Twitter and even you and I sort of meeting. We met in Vancouver briefly. You've been logging a lot of air miles. What's sort of keeping you busy in the business amongst
Um,
all this corporate happenings? What specifically are you doing?
the bulk of my time in these and during this time has actually been on real estate. Typically when we first launched our company previously and had our greatest success, we didn't sign a piece of real estate unless I personally put my own eyes on it. So that has been the mandate so far. I've been in Alberta, Ontario, and Quebec and BC extensively recently for organic and inorganic growth. I just came back from Florida as well, touring the real estate there. So I would say probably 75-80% of my time is in real estate focused. Probably 10% meeting, has been, I call it investor relations, working with our team, working with our existing base. And probably another 10% of my time recently has been spent on M&A. We've been very focused on getting these existing brands, generating meaningful cash flow for us and kind of helping them leave the nest, as they move forward. And Heal is the first one that certainly now as it's entered franchising, and it's the first brand in our portfolio that's left the nest, but now it's also experiencing meaningful growth. So to access the real estate at the pace we're trying to this year, when we want to open 15 to 25 new restaurants, and start to build that pipeline in advance for 2025, then it means it's back like the old days for me, where I'm on the road, actively meeting with the landlords. Sometimes you got to have your elbows up. You go out there, and there's other guys that are aggressively trying to take your real estate. So sometimes I'm
Sure.
going to go in and meet the landlord face to face. Like tomorrow, there's a spot in Vancouver I really want. I prefer not to take no for an answer, and I'm meeting them face to face tomorrow. So we will go to those lengths to get the deals done.
Speaking of that, you also announced another sort of 30 unit area development franchising deal for Joey Turks Island Grill in Ontario. So you sort of announced that brand last year. Maybe you could kind of go into like the synergy of that brand. How did it come to be? How was it formed? How was it created? How did you acquire it? And then I guess you've got your first location open. Must be somewhat successful to move right into 30. So could you give us a little overview and background on that brand?
Yeah, absolutely. As we look at not just emerging brands, you look at emerging categories. And when you look at the categories that are out there today, um, there's a pretty good representation of independent Caribbean across Canada. A lot of them can say, well, there's this amazing lady, she's in my neighborhood, she makes great Caribbean. But there's no really recognized brand and trusted brand across Canada. There's no national brand in the space today. So as we see the influence of immigration and all the different cuisines that are out there, whether it be halal and pieces that as well that different types of from religions and stuff that go into food today, we quickly identified as one of the significant opportunities in the space we believed was Caribbean. I believe it's very underrepresented in mainstream Canada. And from a real estate perspective, there was significant upside growth opportunity to build that brand. So the first thing we did is we surveyed the landscape in Canada, met with a bunch of entrepreneurs that had opened up one or two stores at the time. I think the largest true brand was probably 3 units out there in Canada. We did talk to a few of them. We even proposed say, what would it look like as a joint venture? And we quickly realized that they were out to lunch, in my opinion, as far as value. We felt that there was a much better way to create value for our shareholders, and that was to create our own brand. So we went out, hired an excellent chef, gentleman that had represented in my opinion, one of the early leaders of Caribbean cuisine in Toronto. Brought Tony in, worked with Alex and myself on the food and the menu, compared to what the competition looked like, who we wanted to be when we grew up, sort of thing. And like we just finished last week we just finished our second round of menu iteration that you're going to see new limited time offers and pieces coming to the menu to the very shortly. But the key thing was to get the first store open, validate the model. Had guys come in from across Canada on the franchising side in our network, try the food, quickly validated in numbers as well as in cuisine and franchisee interest. So we quickly then moved into a area development agreement for Ontario, and we are now in the process of having identified our first bit of expansion for Ontario, and we are looking to imminently start opening secondary units from the very first one. So we're happy with the results at this point. Now we're going to look to scale the brand. We are going to look at Alberta and BC as well in the near term, whether that be 2024 or 2025. We will expand the brand outside of Ontario based on the interest that we have today. We're going to greenlight that expansion as soon as we start getting a few more units open in Ontario. So we hope to be able to share that very shortly as we've expanded it. But for a fraction of the money in this situation, we created shareholder value by incubating the brand from scratch and launching it with our team. And now we're starting to scale.
Excellent. Thanks for the overview on that. Why don't we switch gears a little bit? We'll talk financing. So also during this last quarter, since we spoke, you were able to secure some additional growth capital for the business. You announced and closed on your third above market convertible note financing. I think you raised about $1 million in this last one, if I'm not mistaken, and you received it from a fairly well-known investor family. Maybe you could you go through the details of this?
Absolutely. A part of our strategy right from the start was to surround ourselves with smart people that have a lot more money than us, and hopefully, as we execute, they reward us with additional growth capital. They become friendly and help us buy in the float, and soak up the float, and be part of our long-term story. As you mentioned, the first round was done that way, above market. The second round we did was above market. This third round was negotiated when we were way lower in share price, so it was well above market. It happens to be somebody that I become friends with, one of the wealthiest gentlemen in Canada. Happened to be my neighbor, and over time he always said, "Hey, if you're doing something and you see an opportunity where we could play, then please give me a call." So once we had significantly, in my opinion, de-risked the business, I sat down with a gentleman named Paul Paletta. He brought in one of the gentlemen as his CFO and a team, and he launched a company called Trio Cap. They're out of Trio Capital, out of Burlington, where I used to live. And Paul is probably the largest real estate developer, one of them in southwestern Ontario. And he has a strong presence and very well known, incredibly philanthropic. You can't go very far Burlington or in the city and not see land or property that's been donated by his family to the people back in Burlington. So he was a great person for us to be able to tap into, and very much a strategic into the deal, because Paul not only came in above market and wrote a check, but he's also there for us as we go forward. As long as we're executing, he sent me a note the other day and says, "Hey, can we get together for dinner?" I was like, let's do that, and have a glass of wine together and catch up. And I said, sure. Post Q1 fins, Q4 fins. How about we get together and catch up on the business and talk further. So it is a goal of ours to continue to bring in people like that. We've got several of them in our deal that have helped us soak up the float and help fund us. As soon as that deal was announced, we had additional capital, like a significant amount of additional capital that tried to come in, offered to also join that round of the 50-cent round, and we declined all the additional capital. Paul committed to us when the price was in the 20-some cent range to do the 50-cent pricing. So I didn't feel it fair when it moved to north of 40 cents to let other people piggyback Paul's deal. I think, that'll be, we'll entertain that down the road. If we need capital again, do we go back to one of our existing guys and just keep the circle even more tight? Or do we, if another really strategic comes to the table and offered us, again, more money above market, we would survey the opportunities in front of us and see if it's the right decision or not. But bringing in people like Paul and his team, Mary on the team at Trio Cap, was excellent. They're very strategic, and I believe they've been very friendly with us in the float as well.
Excellent. Thanks for the overview. Sounds like a excellent shareholder to add to the company, and congrats on that. How many operating locations do you have now, both corporate and franchised?
You know what? I was just checking that number this morning, actually, trying to see what that came out to. And 16 units across corporate and franchise today. Obviously, that moves up significantly as we close on Via CIBO here. You'll add another, let's say, on total units, another 9 units. So you'll be running 24 units. And our goal this year, we've opened 1 so far. We just opened our first franchised unit, net new unit, and the first one ever for Heel. Just opened up in the beaches of Toronto a couple weeks ago.
Great.
Yeah, huge success. Our largest opening we've ever had in the history of the company. So that's great news to see as well. The franchisee is phenomenal. And he's I was literally out on the weekend looking for sites for him again for his next location. But David, so 16 units today. We'll be shortly in the mid 20s, and with a goal of 15 to 25 new opens this year. We'll quickly be towards the end of this year, I think, getting closer to 40 stores open, with an outside reach of probably 50 units in the company. That's very possible by the end of the year, in 2024.
That's pretty aggressive. Good, excellent. I noticed you also did like sort of a co-location where you took 2 brands and you put them sort of together. Maybe you could explain a little bit about, I know some other famous QSR brands have done some of that stuff in the past. If you think of like, Wendy's and Tim Hortons, and there's a few other examples out there. Can you sort of explain some of the thinking behind that?
Absolutely. And very much, a lot of people that think, early on, including me, in my opinion, that MTY was, all about food. That was one of the biggest mistakes I made in underestimating Stanley and what he was doing when he was trading at 30 cents. And I thought, no way, like, I'm not investing in that company today. They were very much more a real estate play. And if you look at what we're doing today, one of the biggest, dictators or, impact pieces to growth is real estate and access to real estate. So very much this year is this play here, bringing the synergies in on the brands is about access to real estate and improving the unit economics per square foot. So this was something that I experienced at MTY, where they had several brands that would co-brand. A lot of times, whether it's their ice cream brand or one of their smoothie brands or something, would piggyback one of their non-brands, non-dairy or
non-dessert
potentially. Yeah. So non-traditional it happens a lot, but street front, yes. One of the big prominent ones was Tim Hortons and Wendy's. Recently, you're seeing it from one of the pretzel companies and Jamba Juice, and stuff like that, because
right.
Rourke and some of the big brands in the United States are certainly looking at it, right? This Cinnabon and stuff like that. They'll bring in 2-3 brands, access a bigger piece of real estate, have one franchisee operate it all, and our first entry into that, we did it in Burlington with a joint door in between the two, and it was a huge success. It's one of our most successful co-branded units that I've ever seen per square foot. So then when you look at a similar area, similar demographic, healthy lifestyle area, which is right off of Bloor West and High Park in Toronto, it became a natural fit for us. It was a former Church's Chicken location, actually, that had failed. We saw a great, they had Popeyes and Wingstop come in right across the street from them and literally crushed in this situation Church's. So one of the only west-facing patios in all of Bloor West in that area that you could find, has a huge patio, and it will be a co-branded space. So you will see Heal Wellness in one half of the space, and the other half you'll see our brand Let Us Love, which we've already experienced significant success out of Burlington. So that'll be our first one, and we are entertaining more. We've had another opportunity recently approach us landlord wanted Joey Turks and Rosie's. So we literally looked at what would be a way to access our portfolio, great real estate, where the rents are a little bit higher per square foot. So you bring it down by taking less square footage and putting in 2 units. So we are actually looking at that across Canada when the opportunity comes up. But this would be a great gauge. We had a gentleman out of Toronto who has purchased 6 of these combo stores like this. So this is the first of his 6, and I'm submitting paper today or tomorrow on the third for him. And so we look to roll out more of them, but we will continue to validate the model, and Bloor West is next up.
Hey, excellent. Thanks for the overview on that. Bill Ackman, a pretty famous investor, recently issued a letter outlining his bullish case for QSR brand Chipotle, that they're a big shareholder of. It's also in addition to a sizable investment in Restaurant Brands International. I think collectively is about 35% of his fund is in sort of QSR and restaurant brands. Cava, a stock that you sort of talk a lot about on social media for anybody following you. That stock's up about 60% just since January. It's valued at over, I guess today around $8 billion. And that's based upon 309 corporate sort of owned store locations. QSR and fast casual seem like disruptive themes. What do you think of that? We talked a little bit about it last time.
Yeah, first off, whenever there was been historically in my time in the business, anytime there's been wallet pressure and people's money not going as far as it would have previously, they typically do die down. And QSR and fast casual certainly are the beneficiaries of that. Chipotle's numbers and Cava's numbers are excellent. To your point, yes, they're just over 300 units at Cava, and they're worth $8 billion on a corporate level. It's on a per unit, per restaurant valuation. That's actually pretty insane. But Chipotle is, set the mark on that. And I remember reading the story, when McDonald's was the original majority shareholder of Chipotle, they sold their position for $1.5 billion when it IPO'd. Today, those shares are worth close to, I believe, $65 billion. So even McDonald's underestimated the potential growth of fast casual and the category they're in. And a story I read yesterday, fast casual is actually faring much better in the pricing pressures than the McDonald's and guys like that have. Their prices have gone up significantly in a McDonald's compared to the pricing pressure of a Chipotle. They're almost getting real close, and you can go to Chipotle for about the same price you can eat at McDonald's these days. So, and when people are looking at value and freshness and health, I think they're gravitating to the Cavas and the Chipotles over McDonald's. So, both performing well, but I believe the fast casual sector is huge upside. I believe it's Chipotle's not done their growth. They got so much more globally they can do. They've considerably amped up their growth here in Canada. Recently, they've announced a significant push into more stores. I've seen them be more aggressive on real estate than I ever have. I'm sure a lot of the other smaller burrito guys are feeling that with some pressure on their sales and their pricing. But it opens up opportunity for us. I believe us getting into Pyro early, we're getting our first traction with franchisees and real estate and getting landlords on side with allowing us to start expanding that brand across Canada. I think that's going to be a huge advantage for us in the fast casual space and in the fresh Greek, because there's nobody really doing a great job today in Canada of fresh Greek, or in my opinion, for the most part, fresh Mediterranean. So I love it. I'm glad for investors. They're seeing it. They're seeing where the money is shifting, because the consumers are dictating who grows or not. If the sales were terrible at Qdoba and Cava, they wouldn't be opening stores, and they wouldn't be valued at the forward-looking multiples they are. Then the forward-looking multiple on Chipotle is actually insane. It's trading higher than most tech stocks. So, but is it working? Yes, the stores, their average unit volume keeps going up. So that's driving significant revenue for them. And to your point, Ackman, yes, I believe he's in QSR because it's incredibly stable as an overall business. They have a global footprint with RBI. If you look this morning, they made a couple changes. They voted one of their CFOs, one of their guys, to president, and one of their new team. I think there's a reason why we brought on Gary. we were really lucky to get Gary from RBI and Tim Hortons here in Canada when we did, as we brought him on as our SVP of Finance in fall of 2023. He's had a significant impact. He sees the business. He understands what those guys were doing. We're very lucky to have him as part of our go-forward plan here in 2024.
You announced last year that Heel was looking to expand into the U.S. That I think that would be kind of the first foray for any of your current brands to be into the U.S. How's that sort of progressing?
You know what? I was actually on a call with the real estate developers this morning and our franchisee down there. This is a franchisee that's starting off with a commitment of 10 stores. That deal could quickly scale to 50 to 100 stores based on levels of success that we experienced in Florida. But it was initially a start. Literally putting our toe in the water, validating the model, proof of concept that we'll do down there. But it's we're at the point today where we're submitting LOIs and we're working on the real estate. I had a great visit down there. And I think, early franchisees like this, if it goes well, the early value potential of that territory of Florida could be really significant. There's one of the brands that just went up for sale in the U.S. is called Tropical Smoothie. They were just north of 1,100 stores when I checked. They were valued at $2 billion. They're franchised, and don't think that didn't make us pay attention. To what the opportunity is with the Heel brand. So if it was at 6 stores until we just opened our 7th store, the first franchise one in the company. We have 5 more, I believe, today under construction for Heel. And I'm actively, working paper daily on my inbox for new Heels across Canada. Alberta, BC, Ontario as well are happening. And ideally, we are looking to seed the Florida market with our first store this year. Whether that becomes 2 or 3 stores, I don't know. But we initially are trying to secure the perfect, spot that we can, best spot we can, and launch in Florida in 2024. So hopefully that LOI becomes binding based on real estate here very shortly, and Heel being the first, brand in our portfolio that's kind of leaving the nest. It's going to be, basically having its own dedicated team. It'll be reaching, very quickly. That brand's going to be 15, 20 stores with a real pipeline of stores to come behind it.
Thanks for commenting on that. So your stock's down about 30% from highs made in February. What do you attribute the pullback to?
You know what? We were last, you and I first started, I don't know, I think it was maybe 8, 10, 12, 13 cents. We were there forever. Yeah. I think 15 cents, it felt like the elevator was stuck for a long time. And then all of a sudden, next thing you're trading 49 cents. I think some people took profit. We've also had some debentures get converted, which I think as we move forward, you'll start to see that money show up on the balance sheet. So some debenture money got converted. Some warrant money has been converted. So balance sheet is, going into Q1 and Q2 here is in great shape, including the $1 million that Mr. Paul put in. That's a great situation for the company. So I think a little bit of profit taking, a little bit of conversion of warrants to shares, and I think it's just wait for the numbers to start, continue to validate the business. At some point, I think as we continue to de-risk and build value for shareholders, the guys buying today will seem fine. I know I personally, if I was able to be buying on the pullback when I saw 30 cents, I would have been buying. I did place a call to Sean and say, can I buy today? And he said, no, we can't, because as the financials are being circulated and for Q4, that did, obviously puts puts the company in a blackout when you're about to report financials. And we're also, with a significant pending M&A deal that I'd prefer not to be in front of. There's lots of time to buy shares.
Right.
I'm glad, I've had some guys that are close to our circle. One of our largest shareholders, actually, I spoke to him on the weekend, and I spoke to him last week, and I spoke to him this morning. He was like, Sean, I love this. I was so happy to be able to top up my accounts, and this pullback I didn't see coming. So some guys see it as the guys that with cash see it as a great opportunity. The guys that are fully invested go, oh damn, I'm down 10%, 20%. You know what I mean? So
Sure.
playing the long term game. I think post fins and close, you'll see. I would like to see more insider buying. I wouldn't understand why there wouldn't be more insider buying, and as well as exercise of warrants. There's several of us that have warrants and options that'll come up here by June. That you'll see some people, I believe, exercising. So just an opportunity. I don't get too fussed over the the day-to-day fluctuation of it. Sure, I want to create value for the shareholders, but I'm literally focused much more on the business fundamentals. If Sean and Gary were calling and saying we had problem with the numbers or something else, I'd be a little more concerned than I am when a shareholder calls and says we're down 2 cents.
Right. And you guys have had quite a bit of insider buying in the past. So I guess with the Cravit sort of assets, deal sort of going through related party and then your audited annual financials that are due out at the sort of end of this month puts you in a blackout, so you guys can't buy. So that would be
That's
maybe
right.
one.
That's right. Some of that, I think, last
Yeah.
mile was whether the chairman he was buying at, I think 41 cents. So we're not too fussed about the share price.
Right.
I think at some point in time, just like when it was under 20 forever, we never thought it was going to end. It was like a dispenser of shares was stuck open, but we ended up being a much tighter float. I think over time, hopefully the same thing happens at 30, 40, 50 cents. And if it provides a buying opportunity for myself as an insider and we continue to deliver on the financials of the business and we have great support. And remember, each one of those rounds we did were non-brokered, outside above market financing. So, in this situation, I think it's a pretty good deal. We have access to capital. We've had up until, to the point where we're not allowed to. We've had insider buying. We're vending in an asset on very friendly terms. I think the company just keeps getting stronger, and hopefully organic growth now for the remainder of 2024, that leads the charge. And the goal here is very clear, like get to be cash flow positive with no long-term debt and just keep growing the company. There's no secret sauce to anything we're doing here. It's just disciplined, organic, and inorganic growth.
Yeah. Thank you. You kind of touched on, you've got Q4 and your annual audited financials sort of due out. I know you probably can't comment anything too much on that, but should we see any surprises?
No surprises. We have literally said it multiple times. We're trying to become predictable with our growth and with our our path to growth, how we do it. Protecting our cap table, being very mindful of our existing shareholder base, which includes ourselves. And anything that we do every day in our business, we literally look and say, does this help us or hurt us in our pursuit of getting to a minimum share price of $2? So every day, literally, does that help us? No, then we're not doing it. Don't focus on it. Ignore it. It's noise. Move away. And if there's an accretive deal or a piece of real estate that makes a ton of sense for us to sign, that we believe adds to our value creation and help accelerate our path to $2 minimum a share, then we do those deals. So no, there's nothing surprising coming to us. I just hope over time, we become much more predictable.
What else should we cover? What did I miss that you'd like to speak about?
I think the big piece is today we're imminently here going to be 7 brands. We've got room to grow. I think it took M2I about 30 years to get into the United States. It took them, with 24 years to get to 9 brands. We're very clear that we want to beat that, and I hope that over the next quarter or two we continue to show that path forward for us. We've got a great team. Gary was the latest addition. U.S. expansion is on the horizon. So no, there's nothing else crazy that I think you missed. I think we need to continue to prove. The proof is in the pudding. We need to continue to deliver on the numbers. So Q1 will be out. Q4 is out imminently. Q1 will be out in May, as soon as Gary and the team are finished them. So I think you should hopefully slowly stop getting surprised by us when we add M&A, and slowly stop getting surprised when we bring in friendly capital. Hopefully we stop surprising you with organic growth and delivering on the fins. If you say, I want to become very boring, you know what I mean? Because all you do is execute. Like, it's literally boring. So predictable, it's boring. So I know early on you used to hate me using that word. but if you're really good at it and people can trust you, I think it becomes boring in a lot of ways.
Sure.
Yeah.
Sure. No problem. You can own boring. That's fine. You won't forget. But anyways, that's good stuff. I appreciate your time, Sean. I know you're very busy, and thank you for putting in some wonderful time for us and getting a good update. So we'll leave it there.
Okay.
Have a good one, and hope to see you soon.
Thank you very much, Kerry. You too. Have a great day.